Thank you so much, everyone, for joining in. Any in which ways we are going to record and share the session with all the participants who have registered for this webinar. But before we do that, let me introduce myself and my team joining us today for the webinar. So my name is Prateek. I represent Aptiva in the African continent for risk advisory and consulting services. Joining me today are my colleagues, Mr. Satya Vemiredi and Mr. Kautuk. Kautuk is an associate director with us at Aptiva and looks after the practice for ICAAP. He's a subject matter expert on the same and has personally done over 40 plus ICAAP sort of implementations across multiple geographies in Africa, in Asia, in parts of Europe and Americas as well. Also joining me today is Mr. Satya Vemiredi. He leads our practice on the liquidity and balance sheet analytics side. He himself is an ex-banker, having an experience of both sides of the table, I would say, effectively managing liquidity. I will also invite now Mr. John to give us an opening remark, and I am sure he does not need any. Thank you so much. What do you?
Yeah, thank you, Prateek. Hopefully we are all very audible. We can understand that Prateek had a few challenges with his connection, but luckily the presentation is going to be made by his two other colleagues who have pretty good connection. Good morning to you all, and thank you very much for making the time to join us this morning. Aptiva is a consulting firm that we collaborated with last year, right after the, actually, if I say the end of the COVID pandemic, or towards the latter part of the COVID pandemic, we had a very, very successful webinar with them on managing in uncertain times the case of COVID-19. It was such a successful program. It was the opening remark was given by the governor of the central bank. We had the deputy governors on there. We have a lot of the MDs also joining for that particular webinar. We all understand that we know exactly where, as a country, we are at the moment with the IMF program, which has introduced a whole lot of risks to our capital levels and also risk to our liquidity and even solvency generally. So this webinar couldn't have come at any better period. And I'm very hopeful that for all the participants that have had the time to join us, you will leave with some more insights on how best to undertake our ICAAP and our ILAAP, internal capital adequacy assessment, and also internal liquidity assessment programs. As you know, it is already a requirement of the central bank from next year. And therefore, this is coming at a very, very crucial time. I'm just hoping that you all give them the needed attention and take down our notes as much as we can. If we have questions, please let's pencil down our questions. You can also put them in the chat box. And after the presentations, each and every one of you would have the opportunity to put across your questions, your remarks, or concerns, or if there is anything that you need, a template or whatever assistance that you may need in your case, please feel free and share. They are here to assist us. The presenters will be Kautuk, who will be taking us through the ICAAP, and then we have Satya, who will be handling ILAAP presentation. So at this point, without wasting too much time, I will invite Kautuk to start off with the ICAAP. I hope that is the order of the presentation.
Yes, thank you so much, John. So first of all, thank you so much, John, for the introduction, and you've beautifully drawn the agenda and the premise for today's webinar. I would also like to welcome all the members who've joined today and who've spared time to discuss this with us. And as John mentioned, this could not have come at a better time given the existing crisis and the importance of ICAAP, ILAAP, and the stress testing in such current times. So without much of ado, let's start with today's webinar. I would just request the host to enable the screen sharing, please. Thank you. I can do that. Okay. So I hope my screen is now visible and we can get started with today's presentation. So this will basically be split into two parts, the discussion on the ICAAP and stress testing, and then we'll move on to the ILAAP part. It is basically a session divided to be split into two equal halves. The first half, which is approximately around 45 minutes, we'll spend some time discussing about the fundamentals of ICAAP, stress testing, and related areas with the special focus and attention on Ghanaian economy and the context, and especially given the risk management guidance that came in 2021 from Bank of Ghana, it becomes even imperative to discuss these aspects. Now, without getting into much of details, I'll quickly tell you who we are for those who have joined for the first time. Aptiva is one of the most renowned names in Middle East, South Asia, and Africa when it comes to risk management, advisory, as well as analytics and solutions. We've been in the business for almost 18 years now. And in terms of our clientele and the associations, we have more than 100 banks as our client. We have executed more than 500 projects in the sphere of integrated or enterprise risk management, which includes aspects like ICAAP, stress testing, ILAAP, and other related ERM areas. And we work around more than 30 jurisdictions where licensing with the regulators and the local banking associations is something that we usually do. Now, with this, to give you a quick idea about the profile of the presenters today. So as John has already drawn the backdrop, my name is Kautuk Chobe. I'm an associate director right now with Aptiva. I have around 9 years of experience in financial risk management. Being with Aptiva, we have I have particularly executed more than a dozen ICAAP end-to-end development, and more than those ICAAP review and redevelopment exercises across the globe, which includes geographies like South Asia, Middle East, Africa, and a couple of banks in US as well. So this is basically a focused context to who we are. Also along with me, we have Mr. Satya Vemireddy, who is the director and the practice lead for the balance sheet analytics and related aspects. He has also been a banker himself, and as a consultant, he has also helped banks in establishing the end-to-end processes with regard to balance sheet analytics in a holistic manner, which covers aspects like liquidity management, interest rate book, interest rate risk and banking book, and other related aspects. Again, in terms of coverage, he has his experience spanning across 3 continents, and in last 15 years of experience, he has helped almost close to 50 banks in terms of the implementation of related areas. So starting with a little context on the Ghanaian economy, and obviously most of the joinees would know about the existing situation in which the country is. But before we look into the fundamentals of the subject matter that we are going to talk about, it is always good to have some context. So as we know, which has been the situation with most of the countries across the globe, in 2020, most economies saw contraction in their gross domestic product, but Ghana was one of the economies that in 2020 recorded a relatively higher GDP growth rate. However, since then, due to the ongoing program of debt or public debt onloading, there have been issues being faced internally by the bank, which by the central bank, and which got worsened by the external adversities like COVID-19 and the ongoing Ukraine-Russia war. This has exposed Ghana to a surge in the inflation and the rapid exchange rate depreciation. Now, this basically puts an additional pressure on the public finances, and due to this, there is an unaffordable cost currently associated with the public debt situation, preventing the central bank and the ministry to fully deploy the budgeted expenses. Now, in order to make this program sustainable, or to bring the restoration in the debt sustainability, there is a recent initiative being launched by the Ministry of Finance, which is the bond exchange program, to bring back the debt on a sustainable path. Now, with this initiative being launched and the way it is being envisaged, it can be predicted that in the near term and in the midterm, this might have some benefits related to the stabilization of the public debt, which might lead to a significant increase in the government spending, which in turn can pull the unemployment and the unemployment down and the purchasing power of the individuals up. But again, from a macroeconomic perspective, it is imperative to also see the impact of this initiative, as it is in a nascent stage right now. But in crux, this is basically the context within which we will discuss the fundamentals of ICAAP and ILAAP. Now, to give you a historical context also, so what we've done is we've taken a few key indicators of the Ghanaian macroeconomic as a whole. And in this, what it seems is, if we talk about banking and finance sector as a whole, one of the key concerns always remains the NPL, or which is an indicator of the credit risk profile of the bank as a whole, or the banking industry as a whole. Now, though it doesn't seem like there is a close co-movement between these indicators, the macroeconomic indicators and the NPL, particularly GDP or the NPL rate. However, we noticed with some more analysis and some in-depth analysis that if there is a sufficient lag and inertia being taken on the inflation alone, it shows that there is a close co-movement with the NPL rates, which is also in line with the general intuition and the industry consensus that the inflationary scenarios beyond a certain point do tend to make the NPLs or the defaults in the industry as a whole rise, particularly for the individual assets or the retail assets that bank do carry. So basically, this sets a scenario that if the inflationary scenario continues to rise in similar manner, in the few quarters to come, we can also expect the stress to be rising on the NPL front for the banking industry as a whole. Now, with the macroeconomic context being set, let's move on to the subject for today, which is the ICAAP and the related stress testing, and in the other half, then we'll move on to the ILAAP. In the ICAAP, taking a step back, if we see the genesis of where this ICAAP as an accord, or if we call it the internal capital adequacy assessment process. So within Basel II was the first time that Basel introduced this concept of ICAAP, which is the other side of the two-sided coin, which was introduced in this particular accord, which means within ICAAP, the banks internally assess the adequacy of their current level of capitalization, given their risk profile and given their business profile. Whereas the other side of the same coin is the supervisory review and evaluation process, where then the supervisor or the regulator analyzes the bank's own internal capital adequacy assessment process. So in this, basically, the risk that a particular bank could be exposed to were put under two buckets, which are Pillar 1 and Pillar 2. Now, in Pillar 1, the accord specified the three very fundamental risks, which are the credit risk, market risk, and the operational risk. Now, these are three fundamental risks that any banking institution or any financial institution would be subject to in a business as usual scenario as well. However, Pillar 2 risks are those risks which are either partially covered under Pillar 1 category or are not covered under Pillar 1 category. So those risks are left at the discretion of the banks to assess and identify on their own. Now, this is also as an ideology which is inherited by Bank of Ghana in their 2021 risk management draft, which was released, in which the bank or the central bank does list down a few pillar 2 risks, which also includes certain newer risks which are identified by the banks, like the information technology and communication risk. However, the identification, assessment, and the measurement and then capitalization of those risks are left at the discretion of the banks, that they have to choose the particular approach for the purpose of their assessment. So in terms of the whole context, this is how the blueprint of a particular ICAAP or SREP program would look like. Now, in terms of the principles that ICAAP, or the other side of which is the SREP, follows, the two principles that any bank developing and then running an ICAAP as a program has to follow is that, one, that the banks need to have an internal capital adequacy assessment process linked to their internal risk and business strategy. So it has to be a coupled process with the existing business strategy, risk strategy, as well as capital and financial planning strategy. So this is not an exercise that can be conducted on a silo basis. Secondly, the the regulators or supervisors' expectation is generally that the banks do hold capital in excess to the risk that they have assessed, so that there is always a sufficient buffer with regard to it. The other two principles which are for the supervisor or regulator includes that the regulators or supervisors evaluate and review banks' ICAAP program on a periodic basis, and if there are any interventions or actions required where the aspects are non-satisfactory, the interventions need to be taken place in a timely manner. Now, the whole ICAAP process, if a bank is looking to formulate this as an internal framework, starts from the board and management oversight, because this is a process which is taking inputs from multiple departments within the bank, and there are multiple inputs which flow in running of this whole program. So in this process, it starts with a very tightly knitted governance structure, which starts from the board of the bank or the financial institution directly, and then there are management and board oversight committees which are required at different levels to oversee the program and to provide sufficient challenges at different steps. Also, there has to be a sound capital assessment framework. So once the risks are identified, they are measured, the next step is to provide or keep aside capital for those particular risks. In order to do that, what you need, which is the third step, or an interlinked step I would call, is the comprehensive risk assessment program. While each regulator is very prescriptive in terms of the pillar 1 risk being determined, measured, and capitalized, pillar 2 risk, as I mentioned, are always non-prescriptive in nature, and that's where the discretion of each bank and generally the industry benchmarks and peer standards come into play, that the bank needs to formulate the internally developed models, approaches, and framework for those measurement approaches. Once the capital adequacy level is being decided and formulated via those models or approaches, then comes the stress testing, which is, from a reality check perspective, it tells whether the capital is too low, too little, or in terms of its coverage, whether it is covering all sorts of risks that the financial institution is exposed to. Now, all of this has to be viewed, or there has to be an oversight by an internal control entity as well. Generally, it is a mix of the internal and external auditors that the bank has, or also the compliance monitoring that comes from other entities like the internal compliance department of the bank. So from that perspective, there is also a challenge that these independent entities or units give to this whole process, and which maintains that the prudence in this whole process is maintained. Finally, once all of this is formulated, and which then starts to reflect in terms of a report, finally the reporting happens. This report report basically includes the submission to the regulator, the first and the foremost. Also, the internal stakeholders of the bank also make use of this particular report. So this is basically a stepwise process, not particularly in sequence, some of the activities because are parallel, but in terms of the overall scheme of things, these are the 6 steps that any bank needs to follow. Now, the ICAAP process as a whole that we have discussed, this is again a schematic diagram of how things work. So the first process, or the whole overarching process, is the establishment of the governance itself. That includes, in terms of tangible and non-tangible overarching governance entities. So basically, the tangible ones would include the standard operating procedures, the policies, the methodology documents, whereas the other entities or the aspects would include the different management and board committees to provide the oversight of this process. Now, along with the capital assessment process, there's also the stress testing involved. And because it works in a feedback loop, the outcome of the stress test at times is also used again to realign the capital plan and the financing strategy of a particular financial instrumentation. All of this process of assessment of risk and then finally capitalizing and stress testing is then documented within a particular report. Now, this is again an area where different regulators and different banks view it in a different manner. Some regulators or some regimes tend to choose stress testing within the ICAAP realms, whereas certain regulations require banks and its incumbents to provide stress testing on a more frequent basis and stress testing to be filed under different reports. So this is basically and generally driven by banks' internal management and as the regulator's prescription. But in the current context, what we have seen is that generally, though ICAAP remains a periodic exercise, the frequency of doing stress testing has increased in the past 3 years per se, since the COVID-related stress started happening, because the utility of stress testing in particular is not limited only to regulatory submission, but also to internal decision making of the banks. So banks do want to see, and particularly in a scenario where the ground is shifting very quickly, how the current financial standing or the current financial indications of the banks are behaving. Now, this is basically the items which are important from a regulator's perspective that a particular regulator needs to view. So on a high level, what it includes is the overall review and validation of the ICAAP framework of the bank, identifying if there are any areas which require regulatory intervention or regulatory focus, and then finally benchmarking the whole process to the peer regulators or the peer or comparable regulations. Now, this is basically the job from a supervisory review and evaluation process. Moving on to the Pillar 2 risk framework, that how does a particular bank determines what needs to be done with the Pillar 2 risk, because this is an area from an effort and time perspective within any ICAAP filing takes most of the space, because as we discussed, Pillar 1 risks are mostly prescriptive in nature, and that is something that the banks are already doing even outside the ICAAP scope. So in terms of Pillar 2 risk identification, the process starts with the governance, of course, because as any elaborate program requires, the running of this whole process requires a tightly knitted governance structure. So it starts with the identification of units within the bank, who would be the owner of this whole ICAAP process, how the flow would be constituted, and then roles and responsibility of each department, who would contribute what at each point of time. So for instance, if as simple as say the strategic risk has to be measured, which we are going to see later in our presentation, what all inputs from which entities and which stakeholders are needed, and who would collate and then provide a maker or checker overlay on those inputs is what is determined during the ICAAP governance structure. The risk strategy basically determines the risk appetite, policy, and the tolerance limit across which all the risk factors or indicators are seen, and they are measured across different thresholds. Then comes the risk assessment. So once the risk strategy is formulated and you are aware of what sort of risks you are exposed to, those material risks need to be assessed. So for certain risks, one might take a quantitative model or an approach, while for the other risks, the same might not be available. So a more qualitative and subjective approach would be required for the same. Now, from a risk measurement perspective, the choice to measure that particular risk is the most important part, because for each risk type, there are multiple measurement approaches today present in the market, and all of those are acceptable and used in different regimes. Then comes the capital planning. Once the risk measurement is done, the decision to whether capitalize that risk, and if we have to capitalize, how much should be the level of capital. And then finally, we also test those indicators like the level of capital and the related indicators by simulating a few scenarios which are severe enough but are also plausible in nature. And once all of this analysis is done, the final step is to package the same into an ICAAP report. Now, to give you an illustration of, say, a few very commonly discussed risks. Now, this risk as an indication we have taken from, again, Bank of Ghana's 2021 draft for risk management. Now, these risks are given as indicative risk in that particular draft, that the banks do need to consider these risks while evaluating its whole pillar 2 bouquet. But if you look at these risks are already in some or the other manner being assessed by the bank. So for instance, the concentration risk or the credit concentration risk. Now, in terms of the pillar 2 risk, this is one of the risks or approaches which bank are in some or the other measuring. Now, concentration risk in the industry, there are multiple approaches like Herfindahl index or the HHI approach or the granularity adjustment approach, whereas the granularity adjustment and HHI both have multiple variants as well within the market. Now, while the approach selection can be done on the basis of bank's data preparedness and its own business profile, whether it is complicated, whether it is spread out, whether it is extensive across different segments, the question still arises how to capitalize that particular risk. Because, for instance, one might be able to determine the total HHI related to the name concentration of the particular portfolio. However, the question would still remain is how to convert that particular indication or score into a capital charge. Now, to do that, there are approaches which are comparable in nature, but it is again left to the discretion of the banks to decide upon. So, for instance, one might take an internal workshop-based approach where purely judgment-based thresholds can be determined, that if the score falls between, say, a particular criteria, this much of risk charge can be given. So, for instance, I would show that, say, on a simplistic chart that we have. So this is again an indicative chart that we have. Here, say we are measuring the name concentration for a particular portfolio. And as you know, the HHI or a version of it, which is the normalized HHI, would range from 0 to 10,000. So basis where the particular score would lie, you have the slotting of the available capital charge being done. However, in terms of its sophistication, this is still, though a very commonly used approach, rudimentary in its nature, that it involves a fair level of judgment from the modeler or from the bank. However, the other approaches which are being available in the market are a granularity adjustment, which is a derived approach from the same Basel IRB formula. Also, The other thing that needs to be kept into mind is that whether the bank's data preparedness supports such adoption of approaches or not. Now, moving on to the other types of approach, information, communication, and technology, which also covers cyber risk as a sub-risk within. This is a newly identified approach. Previously, it used to be assumed that such risks are already covered under the operational risk, but banks have now started to realize, given their dependence on technology and the solutions, that this risk need to be specially measured outside the scope of operational risk. So there are multiple approaches today via which we measure the ICT risk. There are scorecards available which can convert this risk into a particular score and then to say an expected loss or capital, or there are also slightly more sophisticated approaches using the bank's own loss data experience or industry loss data experience, and then to model it into a risk charge. The other approaches or the other risks which are mentioned within the Bank of Ghana's risk management draft include strategic risk, reputation risk. Both these approaches are measured in a subjective or a qualitative manner, in which there is a scorecard measuring the strategic risk, which basically means what is the risk to banks' earnings and profitability arising from its strategic decisions, is measured by taking key stakeholders and their opinion across a list of key indicators. Similarly, reputation risk is also measured in similar manner, where the key stakeholders of the bank, along with a few subject matter experts from outside, provide an overview or their feedback on few critical indicators related to the gauging of reputational risk. So these are two risks which are generally measured in a completely qualitative and subjective manner. Then also comes regulatory and compliance risk. So basically, regulatory and compliance risk is the threat of losses or penalties or levies which comes from the unadherence of laws, regulations, and the applicable guidelines. Now, this is a risk which either can be measured rudimentarily through historical assessment of losses in a particular category, or there could also be a scorecard based approach. Rather, the more commonly used one is gauging the bank's exposure across different areas where there could be a compliance risk. Then comes the country and transfer risk. However, again, such sort of risk can be measured across both qualitative and quantitative criteria, but generally each risk there are certain inhibitions that the bank carries, that this is the approach that they would be more comfortable with. Now, with the pillar 2 risks being determined, let's go on to the integrated stress testing section. So why we're calling this as an integrated stress testing and not stress testing alone is because in terms of sophistication and the maturity path, integrated stress testing is what typically a bank would want to achieve ultimately in its roadmap of development of its stress testing program. Now, the stress testing comes as an overlay on top of the whole capital assessment and or even the liquidity assessment framework, and the twofold objective of this whole program or framework is, one, to check the waters, whether the capital or liquidity is sufficient enough or not, or is being determined correctly or not, and secondly, to also check whether it covers all sorts of risks that the bank is exposed to by simulating different scenarios based on either the historical data which is there in the industry, or also to envisage a few scenarios ahead in time which have not happened until now, which although they do look plausible in the near future. Now, again, stress testing also, like the ICAAP process, starts with the identification of risks. So obviously, through the internal stakeholder meetings, the subject matter input, and surveys across the different business units, one needs to identify what risk it needs to stress in order to determine the stressed charge or the stressed financial indicators. Once that is done, the second step is basically the assessment of risk, where the scope and the coverage starts to come into picture, where it is actually realized that each risk, when assessed, covers or impacts what portion of my portfolio, and also whether the sources of that risk lie within the bank, which is a bank specific scenario, or whether it comes from outside, which would be a systemic scenario or a macroeconomic scenario. So once this assessment of risk is done and there is a particular approach being chosen for each risk type to be assessed, then actually comes the measurement of risk, where the most simplistic of the approaches include a sensitivity based approach. Now, a sensitivity based approach could be as simple as, with every 1% drop in GDP, can I assess what would be the rise in my default rate? And then when the default rate rises, can I also see how much my capital charge goes up by and how much the provision or related indicators would get worsened. So sensitivity is just moving one single lever at a time and then seeing the impact of the same on the financial indicators. Whereas the scenario analysis is a slightly more complicated but a definitive approach, which is closer to the reality, where a number of indicators are moved in a holistically netted scenario, which is a more realistic scenario. So for example, in a recessionary scenarios, it's not one single indicator which would go bad. There are multiple scenarios which in a ripple effect would happen, and then that's how it would spin. So scenario analysis is a more holistic approach to see the bank's financial profile under different types of stress. Once the measurement of risk and the charges within the stress scenario is seen, then the next step is basically to determine what sort of actions that the bank can take and what are at its disposal. These are reflected across documents like recovery and resolution plan and the contingency funding plan. So the question that you might ask is that once the capital assessments is done under ICAAP and the stress testing is also done, and we know how the financial position would look like if any of this scenario is to crystallize, the next step is basically what do we do after that? Now, as this is a completely feedback knitted process, the actions post the determination of a stress scenario is that the actions are actually listed from the management side, that for each scenario, what avenues are there for the purpose of recovery and resolution. And this is generally split by banks which are at that level of maturity across a recovery and resolution plan, which is generally considered to be a capital centric plan, whereas the other one is a contingency funding plan, which is considered to be a liquidity centric plan. Now we'll come to the planning and the inclusions of those documents slightly later, but let's also see how generally and in a practical scenario a stress testing exercise is being done. So in terms of risk determination, first process that any bank would want to do is to make a laundry list of the external and the internal factors through which it could be exposed to in terms of financial risk. So say these are the list, not limited to the internal and external factors that can impact the bank. Generally what happens is, why these are required to be seen in silo and then in a combined form is because the banks carrying best of the portfolio can suffer under bad economic times, and the banks carrying substandard or subpar portfolio can also do well during good economic times. So both do tend to matter, and obviously in a practical scenario you would see both sort of risks invoking or crystallizing together. So the process starts with, say, a bank specific scenario being run, and then in silo the market wide scenarios being analyzed, while the banks also tend to analyze the combined scenario. So for instance, if we were to combine a single scenario, it can be a scenario like there is, say, adverse movement in the GDP growth rate along with some top defaults happening in our own portfolio. So one is idiosyncratic in nature, which means there is no external indicator or a shock impacting the same, and the other one is market wide, where the bank's own risk profile makes no significant impact, which is basically completely external. So in a recessionary scenario, it might well be the case that both may happen together. Also, across risk type, you might find that different types of risk invoking at the same moment. So it could be the case that the liquidity crunch is happening at the same time that the defaults are increasing in the market. So it increases or shows increase in both credit risk as well as liquidity risk. Plus, there are ancillary risks as well. Now, the stress scenario designing, once that is being done, it is also a general practice by the banks to slot it across different variations of severity, calling it mild, moderate, and severe, and then assessing the impact of these scenarios across different financial indicators. So there are different financial indicators that the bank chooses from, that these indicators are the ones where we would be seeing the impact of the stress scenarios. Yeah. So also to give, actually, this is more for the hands-on team members which are here with us today. This is how typically the IST or integrated stress testing data landscape lies. It basically shows that if you have to conduct an integrated or a holistic stress testing exercise, the data would come from so many sources. So it would start from the portfolio or customer specific data. You would require data related to the economic scenarios, the asset quality related data, the financial projections from the finance and strategy team, the interest rate risk related data, liquidity data, and data being run from other pillar 1 risks like the market and the operation risk. So this is an indicative blueprint or a mapping of what all data requirements are there in terms of running an IST program. Now, to give you an idea about how typically, say, a scenario is being run and how the interlinkages sort of come out. So generally, the practice that we follow is basically showing the impact of any stress scenario across a set of parameters, where the standard CAMELS framework from the industry is follow, which splits the indicators into capital adequacy, asset quality, management related parameters, earnings, and the liquidity. So for instance, one single scenario, if we see, say, the default of top 3 borrowers or top 3 groups within the bank, can impact a number of parameters. So it can, via the liquidity gap statement, impact your cash flow or liquidity gap statement, and then can impact your liquidity related parameters. Of course, through your rise in PD and the LGD via NPL and the increase in provisions can impact your RWF. For instance, if the RWs are being measured by IRB approach, or also from standardized approach perspective, but the provisions would rise in any case, whether the bank follows the IS 39 or the new IFRS 9 guidelines. So in both these senses, there is an impact on capital as well. So we have seen it impacts liquidity, it impacts capital, and because there are losses being booked from the P&L, it would also impact your profitability. And then all of this, one single scenario being happening, all of this would also impact the ancillary scenarios. So one single event basically triggering or trickling down to other risk indicators, and then we would see the impact of one single event happening across a range of financial indicators. So this is again a schematic of how one single event like a global recession can turn so many other risk types. So for example, in a global recession, there would be a liquidity crunch, both from banks' own liquidity profile being carried, and also as a market would be deficient in terms of the total liquidity. With the adverse movement in the Forex and the AFS valuation losses, there would always be an inherent risk on the market risk side. Whereas in the same recessionary scenario, you would see a lot of your large customers undergoing rating downgrades, which would then trigger the stage slippage and the increase in the ECL provision. Also, if it is linked to an IRB based capital, you would see the capital charges also going up. So basically, while the focus of the whole risk scenario is one single event, on the core of it, though it looks like a single event, there are multiple events that are happening in tandem. And this is practically how any stress scenario turns out. And that is the reason why doing stress testing on a silo basis and doing it only from a reporting perspective does not help, at least on a practicality basis. It is always imperative to do it on an integrated basis. Now, I'll quickly also show a few sample table of contents, but there's an interesting feature that we wanted your attention to be drawn. So we've taken a sample template over here, just so as to showcase, how typically an integrated stress testing exercise is being done. So what banks tend to do is, for instance, you can pick and choose, okay, I would want to do it, say, on a standardized approach basis when we're talking about the capital charges and the capital related approach, and let's do it on the full group. When such decisions are being finalized during the course of formulation, you would see, for instance, there is one scenario over here, let's call it a protracted global slump, which is meaning a prolonged global slump which would continue. And along with that, we can also say that top borrower, or say the top exposure from the exposure type, also defaults along with it. Now, these are two scenarios happening in tandem, but you would be able to see the impact of the same over here. So for instance, not only on the face of it, though it looks like a credit risk scenario, your other indicators would also get impacted just because of that. So you would see your asset qualities, your earning, your liquidity, all of this gets impacted immediately the moment this whole scenario impacts. Although the impact on liquidity is very small, but yes, there is an impact on liquidity ratios as well. So this is basically how, in terms of operationalizing the whole process, a scenario works, that one single scenario, when selected, it not only impacts your capital adequacy ratio, which is the general notion for stress testing, but impacts all of your ratios. And if we are not viewing that, basically we are actually undermining the risk identification. Now, coming back to our discussion, typically we just wanted to showcase how an ICAAP report or an integrated stress testing report would look like. So in terms of its inclusions, you would notice everything starts with a tightly knitted executive summary, but there's also a governance angle being brought in, which is required from a regulatory submission as well as the internal stakeholder perspective. It involves all the detailed documentation related to model and the approaches which are taken for the purpose of Pillar 1 and Pillar 2 determination, and the capital planning and the inputs that are coming from different sources. Now, as you've seen, it covers in detail all the inputs that come from different aspects and the approaches that the bank has taken. So documentation is one of the areas which, in terms of time consumption, requires a lot of focus when ICAAP or stress testing reports are being formulated. Similarly, each scenario needs to be defined, elaborated, and explained in great detail when an integrated stress testing report is being formulated, and the impact of each scenario is then interpreted, discussed, and related to the management actions later on. This also gives an idea about the other two ancillary documents which a bank should formulate along with its ICAAP and stress testing program, because without a CFP or an RRP, the stress testing is incomplete. Basically, it would then mean like there is a diagnosis being done in a 6th stage, but then there's no action being taken. So without an RRP or a contingency funding plan, the stress testing remains an open-ended exercise, and there's no feedback that is being provided for the purpose of a rectification. Also, if you notice on RRP alone, there are certain elements which act as a ready reckoner in case any of the scenario invokes in the future. Bank can take this as a ready reckoner, and this reduces the turnaround time or the reaction time that it requires to act under each scenario. So for example, if there is a scenario where there is a capital shortfall being shown, it would list down multiple avenues that the bank has already identified for the purpose of filling in that gap. And there are also thresholds by which the regulatory intervention can be determined. For instance, if it falls below this level, there would be a board intervention. And then if it falls below a certain level, you would want the regulator to intervene. So basically, this brings us towards the last part of today's exercise before I hand it to Mr. Satya for taking us through the ILAAP session. This is a quick recap of all the questions that we have tried to touch base upon in our discussion through the journey of ICAAP and stress testing. One question that the banks have been asking before even the regime of ICAAP and stress testing came is the solvency and sustainability. That do we have enough capital to achieve our target risk profile, and under the risk appetite, do we have enough buffer that it would last a few stress or shock scenarios. The regulatory dialogue is the second part that you would want to answer in this whole process, that whether the current prescription is right or not, how much above should be or how much additional capital should we have over and above that. Then comes the limit setting. So setting limit in terms of tolerance of different risk types to view the same aspect in different cuts is what limit setting is all about. Then comes the portfolio analysis. As this is a feedback-based exercise, you would want to realign your portfolio strategy, your business strategy based on whatever outcomes come from this exercise. And then it is also linked to your pricing. So whatever happens within this exercise, you would want your pricing to also be aligned according to this. So for instance, you might realize that though certain portfolios on the face of it look profitable, but they do eat up a lot of capital and provisions ultimately, and risk adjusted returns are much lower in comparison to other portfolios which look lesser profitable. So you would want to realign your pricing in those aspects. So risk adjusted return on capital can be done on both ex post and ex facto basis. Balancing the member value. So one of the whole purposes of doing business is basically adding to the stakeholder value, and the economic capital attribution and the economic pricing basically gives us an idea about whether the bank continues to add that stakeholder value or not. And then a couple of slightly philosophical questions are we underestimating in any manner? Because this is a fine balance between not underestimating or not overestimating, because underestimating has a risk related to the sustainability and solvency of the bank, while overestimating too has challenges, right, like making the bank unviable or increasing the cost itself, because each penny of capital or provision that you keep aside has a cost associated to it. So you wouldn't want to over or underestimate grossly. And then the final thing is that when all the stress testing then arises, the question so on. So basically this is where I'll take a halt now. We have Q&A after this, but I think we'll take the ICAAP session also. My colleague Satya can take it from here, and then probably Q&A we can do in a combined manner later.
Thanks, Kautuk. So let me just bring up the presentation. I hope the screen is visible.
Yeah, we can see your screen now. Thank you.
Okay, great. Macroeconomic environment that globally that's prevailing because of the after effects of COVID lockdowns and relating supply chain issues, as well as the ongoing crisis in Ukraine. Now, when we talk of liquidity, and of course, I mean the name, the ILAAP name, which is which draws a parallel to the ICAAP process, in that it is trying to do a comprehensive analysis of the liquidity position of a bank on the similar lines of identifying the primary pillar 1 risk as well as all the pillar 2 risk. So the entire idea originates, of course, from the 2008 global financial crisis, which originated as primarily as a liquidity risk, and then gradually led to a contagion effect and and morphed into a global financial crisis. And one of the key learnings from a regulatory perspective, from that crisis, is that liquidity risk cannot be managed by charging a capital requirement on that risk. So prior to a number of banks adopting ILAAP and also even LCR and NSFR, liquidity risk was considered under ICAAP as well, and certain capital charge using various methodologies was being derived, and then certain capital being set aside. But the reality is that liquidity does not just impact capital, but more immediately it impacts the viability of financial institutions, as a whole. So that led to a number of regulations coming in, notably LCR, NSFR, to ensure that banks are able to sustain or meet all a moderately stressed scenario for a period of 30 days using their own internal resources. So that's where LCR comes into picture, and then to support that over a 1-year horizon, so that the funding profile is stable enough to ensure that over a medium to long term profile, if the bank continues to have sufficient level of liquidity and funding profile. Now, and then further on, so LCR and NSFR were very good starting points in terms of how liquidity should actually be tackled, liquidity risk should actually be tackled within banks. However, there was still a number of underlying issues even within those ratios. Like, for example, LCR, when you look at the overall ratio, you're on the numerator, you're looking at total HQLA available, post any adjustments, and then on the denominator, you're looking at the net cash outflows. But what is the source of those net cash outflows? What are the key risks? What factors impact the inflows, and what factors impact the outflows? And whether the and within the NSFR, which items contribute to a higher funding requirement, and which are more stable, which funding sources are more stable than others. So there are a number of finer details that have been left out of the LCR and NSFR framework in the interest of standardizing the liquidity risk measurement across the globe. So LCR and NSFR have become a global industry standard in terms of measurement of liquidity risk. Whether it be credit assessment of financial institutions, rating assessment, or evaluating the performance. So these two metrics play a key role. However, when we try to look at each bank, so obviously each bank, the balance sheet structure, fundamentally differs from each other in terms of the composition of the assets and liabilities, the tenor profile of various assets and liabilities, the inherent risks within their customer base and based on the sectors that they target. So there are a number of underlying issues that need to be brought out and presented to the management. So the key objective of ILAAP was to perform a similar comprehensive analysis on the lines of ICAAP as part of the Pillar 2 supervisory approach, to ensure that banks fully understand all the underlying sources of its liquidity risk, and also ensure that the banks are setting up adequate systems and processes to monitor historical, current, and future liquidity requirements and liquidity availability, both under normal as well as stressed situations of various horizons. So that essentially ensures or gives a kind of an assurance to the regulator that the bank has in control how historically it has managed its liquidity, and also in terms of understanding what future requirements of liquidity the bank would face, and whether it will be able to meet those requirements even under stress. So these, the key points displayed here on screen currently are, the 8, pillars of ILAAP, which are incorporated as part of, the final ILAAP report that, banks submit to regulators. Incorporating all the various aspects of liquidity risk within the bank, starting with governance, the funding strategy, assessment or regular assessment of liquidity availability, and how the bank sets up and defines its risk appetite and how it monitors it on a regular basis, and performing stress testing and incorporating the pillar 2 risks along with monitoring the impact of the stress on pillar 1 measures like LCR and SFR. And pillar 2 risks are essentially those underlying sources of liquidity risk that banks need to monitor and model as part of the stress testing exercise. And then the contingency funding plan, which already Kautuk made a mention of, in terms of once you perform a liquidity stress test, then what are the available sources and what is the action horizon on each of those available sources for you to be able to utilize and restore your liquidity positions and meet the stress cash outflows. And finally, a full adoption of this entire framework within the bank, organically, in that you include elements of ILAAP, right from strategic planning to governance, to regular monitoring, to performing stress testing, and even taking optimization or taking a feedback from the entire analysis in terms of readjusting the balance sheet in terms of the liquidity levels available, and whether the framework and all the assumptions and the computations that are going into these kinds of analysis, are they sufficiently adequately reviewed and sufficiently challenged within various management committees, and whether sufficient questions are raised and whether there is an independent validation of this framework. So all these questions go into the adoption aspect. So we can look at each of these aspects in subsequent slides. Starting with the key definition of liquidity risk and its the sources of liquidity. So Basel Committee has defined it as the ability of a bank to fund increases in assets and meet obligations as they come due without incurring unacceptable losses. So this essentially is the liquidity, and the risk to the liquidity is that the bank is unable to meet its obligations or faces significant losses while meeting its obligations. And to overcome the liquidity risk, there are various sources and types of liquidity that are available, which are classified even within the regulation into a short-term liquidity, which is primarily or high-quality liquid assets as defined by the LCR liquidity coverage ratio guidelines. And the primary objective of HQLA is to enable the bank to meet immediate cash outflow requirements. And this may include your cash holdings or your reserve balances with the regulator, and highly liquid securities like government bonds, treasury bills, which can easily be sold or reported in the market to raise funds. And then the second aspect is the structural liquidity, or what is called the funding liquidity, is that when you build a balance sheet and when you look at your maturity mismatch report, you look at the cash flow profiles of various products, and you see that certain products have a short-term profile, certain products have a long-term profile. But as you go through the life of the bank, you realize that whatever you booked into the future, they eventually come to mature, and then they become a short, they come within the short-term horizon. So the actions that you take to build up the longer horizon book will eventually, materialize into risks in the short term. So this could be, booking, a lot of heavy mortgage portfolios, or concentrating maturities in a few buckets, or essentially building large mismatches in the longer tenor buckets, which eventually will be realized into a short-term bucket. So to avoid those kind of mismatches in the medium to long term horizon, so the regulators have also defined the NSFR ratio, net stable funding ratio, that ensures that there is sufficient level of distribution within less than 1 year and greater than 1 year horizon, both on the assets and liability side. And this essentially assigns some weightages based on whether assets and liabilities are shorter than 1 year horizon or longer than 1 year horizon, based on the funding requirement and the funding availability of these sources. And then, so these are the two primary source of liquidity, and where the interplay between short-term planning and long-term book come into picture. And in addition to this, so there are a number of aspects within this, including your currency-wise liquidity, where if you are operating in multiple jurisdictions, so the liquidity availability at a group level may be sufficient, but maybe the liquidity within a particular entity may not be sufficient, given the HQLA holdings in that particular currency may not be sufficient to meet the cash outflows. Or there could be, even if there are two jurisdictions with the same reporting currency, or holdings of HQLA in the same currency across two jurisdictions, it may not be possible to transfer the liquidity available within one entity, where there might not be stress at the current point in time, to another entity where that could use that liquidity. So there might be regulatory restrictions in terms of capital transfers, or sudden issuances of loans or funding to other jurisdictions that could limit the ability of transfer of liquidity. So these are two additional factors, and very important factors, that could be that should be considered when performing liquidity analysis. And there are a number of other sources of liquidity, liquidity facilities provided by other financial institutions and the regulator. Strategic funding windows with the regulator, capital market issuances, as well as intraday liquidity sources originating, or risks originating from the payment and settlement systems, where a number of counterparty banks that offer correspondent banking services offer liquid facilities in certain currencies. So now this essentially sets the context in terms of what is it that we are trying to monitor, and what is it that we are trying to optimize in terms of adequacy of the types of liquidity. And then, so now that we have set a context in terms of what are the various types of liquidity that we want to set adequacy for, and then we look at the overall framework, in terms of the life cycle of liquidity assessment. As I mentioned initially, that ILAAP needs to be incorporated into the entire planning process of the bank, starting with the strategic planning exercise, where at the budgeting and business planning phase itself, and at the strategic level, of course, there needs to be a general view in terms of the level of liquidity that the bank needs to maintain, a minimum level of liquidity that eventually crystallizes in the form of risk appetite limits, driven from the view of the board in terms of their appetite for liquidity risk taking. And whether that growth in turn lets you manage and maintain liquidity risk metrics within the set up liquidity risk tolerance and limits. And if not, there needs to be changes to those plans to ensure that that the liquidity metrics are within the tolerances. And then comes the risk framework itself, the overall governance framework, to ensure that there are clear definition of the roles and responsibilities, starting with the board level and senior management and managing liquidity, in terms of who's responsible for setting up the framework, who's responsible for reviewing the framework, who's responsible for setting up the policies and procedures, and in terms of the data, in terms of the risk models, in terms of implementation of those models, in terms of monitoring those metrics on a regular basis. So all these aspects need to be adequately covered in the risk framework. And and then the next aspect is the liquidity assessment, in the sense that what various measures that are used by the bank in measuring liquidity, whether it adequately captures all those types of liquidity that we just discussed and various other sources of liquidity risk that could possibly be hidden within the book. And whether the analysis includes behavioral aspects of the customers involved and their response to changes to macroeconomic environments. And this also includes whether, given the business growth projected as per the business plans, what would be the level of liquidity ratios in the future, given you adopt these business plans. So the liquidity assessment not only looks at a historical level of liquidity maintained by the bank, but also looks at future level of liquidity metrics and availability and requirements given the growth plans. And then so once we have set up a robust framework, and we have ensured that on a regular normal BAU basis we are managing the liquidity in a comprehensive way. The next aspect is to look at stress testing. So fine, I mean, the BAU is doing good and all, but let's say there is a stress that occurs starting today. What would be the response of the balance sheet to that stress, and how would it impact my liquidity metrics, and how do I translate the definition of the stress onto the in a quantitative way so that I can apply it on my balance sheet, and how can I then reassess the liquidity metrics and relook at gaps to assess how this is affecting these metrics, and then from a contingency funding plan, understand what sources of liquidity, either internal or external, are available for me to action upon, and bring back the level of liquidity that was prevailing pre-stress. So, and then within this context, many regulators are also asking banks to set up a risk appetite framework that looks not only at the normal operating conditions but also under stress. So when you are, let's say, in BAU, because there are already regulatory guidance in terms of LCR and NSFR that they need to be at least above 100% for BAU. But whether banks should strive to maintain the same level of 100% level even under stress, or whether they should set up lower level of thresholds so that when there is stress they can still operate below the regulatory thresholds. So that is where of course, I mean, this is not that if the bank suddenly decides to have a higher liquidity level just because as part of stress testing they have seen that the post-stress ratios are going below regulatory thresholds. And regulators do understand this, because the overall objective of the LCR and NSFR ratios is to ensure that banks are maintaining at least a 30-day buffer to meet the 30-day moderately stressed cash outflows. But if there is severe stress event or a stress event that prolongs more than the 30 days, it is clear that the ratios will dip below the regulatory thresholds, and that is where the stress limits come into picture, and informing the regulator well ahead that as per the assessment there might be a breach immediately in the aftermath of the stress before considering any management actions, and therefore these are the level of stress limits that we set up and ensure that let's say LCR at 80% is something that we will not breach under severe stress, even after start of severe liquidity stress. And then all this analysis finally needs to flow back into the final the active management of liquidity within the bank in terms of the levels of liquid assets available, whether the bank needs to increase the levels or whether there is a scope for further optimization in terms of the liquidity, or whether they should consider increasing the tenors of their funding profile, so on and so forth. So there could be a number of decisions taken to correct the the weaknesses in the liquidity profile of the bank. And essentially, this process is a continuous process, but the objective of the regulator is that banks document a summary of all this analysis that happens throughout the year in the form of ILAAP report that is typically submitted to the regulator. And the objective is not that banks look to just prepare a report for the sake of regulation and give it submit it before the deadline. The idea is to ensure that this process is organically manifested within the bank, and the ILAAP report just documents the actual facts on the ground, and then gives a picture of the liquidity profile of the bank to the regulator under both BAU and stress situations. So there are a few slides that explain, we just talked about, in terms of governance framework, some key elements that needs to be ensured that are part of the governance frameworks, is starting with, strategic overview of how the bank wants to, strategic view of how the bank wants to manage and maintain its liquidity positions. That take into account the business plans and growth aspirations. That translate into the risk appetite limits, either in terms of the Pillar 1 ratios, which include LCR and NSFR, and the level at which the bank intends to maintain these ratios, even though the regulatory thresholds may be 100%. But many banks choose to maintain these well above the regulatory thresholds. Even global banks operate anywhere between 120 to 150% of LCR, and somewhere between 105 to 115% on the NSFR. That is typically what we see globally. But there are a number of banks and jurisdictions where there is high liquidity, where you see banks having LCR of anywhere between 150 to 200. And similarly on Pillar 2 measures, there are a number of other funding and other liquidity risk related measures, like funding concentration by source, funding concentration by sector, top depositor concentrations, structural mismatches like 1 month mismatch, and other stress ratios. So, for example, LCR under stress, NSFR under severe stress, as per the specific stress definitions developed by the bank. So all these can be part of the risk appetite and the limit management monitoring framework. And the other aspects mentioned below are common across the risk management framework, in terms of setting up the necessary risk infrastructure that enables the bank to regularly measure and monitor these risks, and also escalate any breaches, and ensuring that sufficient level of analytical tools or sophistication of analytical tools available for the key personnel to perform the analysis, and tie it up into the Pillar 2 assessment and ILAAP reporting. And when we talk about assessing liquidity risk, so there are a few aspects that are specifically referred to in ILAAP requirements. Starting with the minimum Pillar 1 requirements, where regulators ask banks to assess whether their level, the Pillar 1 metrics are adequately monitored, or the Pillar 1 liquidity is adequate. So this essentially means LCR, NSFR, and any other regulatory ratio definitions given by the specific regulator. And if the availability of liquidity and requirement of availability and the buffers embedded within those ratios, can be demonstrated historically. And then within the Pillar 2 assessment, typically this is a mix of a quantitative assessment in terms of the liquidity stress testing, as well as a qualitative assessment in terms of the stress of the strength of the bank's liquidity risk management framework, the level of automation achieved, the maturity of its liquidity risk analytical processes, and the quality of reporting that goes to the board and ALCO, in addition to other aspects which are not usually covered in the Pillar 1 ratios. So, for example, structural mismatches, funding concentration, overnight liquidity positions, intraday liquidity, cross-currency mismatches, and of course, the detailed liquidity stress testing as just mentioned. So the core analysis of ILAAP and a large part of ILAAP goes into the Pillar 2 assessment, that tries to bring out the most basic or fundamental assumptions and risks inherent in the books. And to assist in bringing up those risks, definitely banks need to consider performing behavioral analysis to understand from a funding perspective. Usually current and savings accounts or non-maturing deposits, as they are called, form a core aspect of funding of most of the banks, and the stability or core non-core assessment of these deposits and the historical decay observed in these portfolios is a very important analysis to be performed to give a sense of what level of runoffs the banks can expect in the case of severe stress, or if there is a bank run, to get a sense in terms of quantitatively understand historically what have been spikes in runoffs observed within the bank's deposit portfolios. And similarly, there are a number of other analysis that can be performed to understand the rollover of deposits and drawdowns on off-balance sheet products like LCs, LGs, and undrawn credit commitments, which may also further increase the liquidity requirements. And all of this is to be brought together in the form of a dynamic forward-looking analysis. And the regulators are prescribing banks to adopt a dynamic analysis to perform liquidity, because liquidity risk cannot be looked at a portfolio level. You really need to break down liquidity into various short-term buckets, starting with overnight, 1 week, 1 month, and until a 3-month horizon typically, to really understand if there is a stress tomorrow, what kind of impact it will have on an overnight basis, on a 1 week basis, on a 2 weeks basis, and then 1 month and until a horizon of 3 months. And then within this dynamic horizon, so how do you build in the risk linkages in terms of how the stress translates into the deposit runoffs, how the stress translates into delinquencies, so on and so forth. So we'll look at those in a bit. So these are just some of the key risk measures typically banks use. I'll not go into too much of detail. So these are traditional liquidity measurement tools. We've already discussed some of these aspects in the Pillar 2, what all aspects are monitored, and the behavioral elements and the maturity of liquidity analysis. So in the interest of time, let me quickly focus on the stress testing aspects. So globally, there are a number of jurisdictions that have issued the internal liquidity adequacy assessment guidances, and a common feature in terms of how liquidity stress is defined from a liquidity perspective, stress is defined, is to ensure that that there are scenarios that capture stresses originating from the market, that is because of either shocks to certain market specific parameters that impact liquidity within the system, or some external event that could trigger a liquidity stress within the market, like, for example, default of a large financial institution, that may, create a ripple effect into other, systems and bank liquidity positions, as well as scenarios that, incorporate institution-specific risk factors, or what are typically called idiosyncratic stress scenarios that, look at and assess the internal risk profile of the bank in terms of its concentration, in terms of, deposit concentration, in terms of its own funding liquidity risk, whether wholesale funding risk, retail funding risk, and the level of runoffs that it typically, observed, and the level of delinquencies and top asset defaults that may impact cash inflows, and reputational risk related events that could trigger a credit downgrade and drawdown of deposits linked to credit quality. So a number of such aspects are covered in institution specific or idiosyncratic stress scenarios. And in addition to these two, so regulators also recommend to use a combined scenario where both the external stress and the internal stress occur together, to create a very severe kind of scenario. And typically the horizon, as I already mentioned, starts with overnight 1 week horizon to leading up to a 3-month horizon, because liquidity stress typically is a event-driven stress, and not stress that materializes over a very long time frame like credit stress does, like typically over a 1-year horizon, which is sensitive to macroeconomic environment. But on the other hand, liquidity is largely event or a shock driven stress. So it could be because of sudden change in external environment, like for example the recent start of the war, and because of that sudden shocks to commodity prices and oil prices, and or sudden increase in food inflation on account of non-availability a number of food stocks in the market. So all these kinds of events that could suddenly trigger liquidity unavailability or liquidity stress within the market. So yeah,
just to interrupt Ravi,
so Pratik, you faded out again. You need to.
Yeah, hi. Can you hear me now?
Yeah,
we can hear you.
What I'm saying is that we are almost at the end of our time today. So maybe if you could wrap up and we can.
Yeah. Yes. So there's just only a couple of slides left, so I'll just quickly wrap up. So, well, performing liquidity risk, as I mentioned, in terms of quantification, so there are a number of aspects that we look at using historical data in terms of the delinquencies in asset portfolio, in terms of runoffs and rollovers on the retail funding portfolios, devolvement of LCs, LGs, and drawdown on liquidity facilities from a off-balance sheet risk perspective. So these are the key pillar 2 risks that regulators typically define. Spike in pricing because of interest rate shocks and liquidity premiums, that lead to increase in cost of funds during the stress period. Marketable assets risk or increased volatility on securities and other equity instruments that may limit the liquidity availability or even FX convertibility, and wholesale funding risk in terms of calls on debt instruments or runoffs of liabilities linked to credit quality and other wholesale funding sources, and funding concentration in terms of top 3, top 5 depositors and the risk of their runoff, and intraday liquidity, in terms of insufficiency of intraday liquidity buffer to meet net cash outflows that happen through the day. So this could be on account of your settlements outflows going first, and inflows getting limited to the end of day, because of which the intraday net cash requirement may increase during the day as the day progresses. And transferability risk, as I mentioned again, in terms of being able to transfer the liquidity availability from one entity to the other within the group structure. And there are a number of other idiosyncratic risks, related to credit rating downgrade, reputational loss, strategic risk, and other bank-specific adverse events. And all of these factors, come together in defining how we set up, a market-wide stress scenario, a bank-specific stress scenario, and a combined stress scenario. So what we, usually what is done is to link the risk factors, which include, the runoffs, the haircuts, the deposit pricing, the prepayments, rollovers, devolvements, and drawdowns. So all of this historical information is, linked with the macro factors to understand the linkage between, the market parameters, which, for example, credit issuance, oil prices, and money supply typically, which represent liquidity situation in the market, and how these risk factors respond to those key indicators. So that is one way of linking, the market-wide stress into the bank-specific factors, and then idiosyncratic stress like top depositor drawdown, or high rate of delinquency and bank runs. So all of these are modeled as part of the idiosyncratic stress. And we also consider, typically, a lot of business constraints in terms of what is the maximum, deposit origination capability of the bank during stress, so that, in terms of managing the actions or to meet the cash outflows. So let's, in the interest of time, the CFP is something that Kautuk had already touched upon earlier. The objective of CFP is to understand the available source of liquidity during stress to meet the cash outflows, which are, typically segregated into immediate actions to meet, the cash obligations, like, liquidating your available securities, or, high quality liquid assets, or repoing them to generate cash. And then short to medium actions like borrowing from, stable customers, or attracting costly deposits, or, drawing down on some liquid facilities purchased. And then strategic actions to restore, or address structural liquidity issues in the long term, like issuance of debt, once the stress scenario is subsided. So just to wrap up, in the current macro context, and what impact that exchange program could have on the liquidity situation. So the idea, behind, ultimately the objective of the regulator is to ensure that, the inflation is kept in control, and the banking system is resilient to external shocks, and it also restores the confidence, within the economy, so that there could be a kickstart of economic activity and investments that flow into the country. So in terms of the current context, there is huge food inflation. Despite Ghana being a strong agricultural producing nation, there's still a lot of food products that are imported that could impact the local inflation. And similarly, there is a lot of shocks and volatility in oil prices, given the dynamic nature prevailing, and where Russia, Ukraine have a lot of say in how these are priced. And similarly, again, commodity prices are also seeing a lot of volatility. And oil, Ghana being having a significant oil-dependent economy, as well as the number of commodities that it trades and exports. So these the shocks in these factors will directly impact, of course, starting with the delinquencies in the credit portfolio that may reduce the cash inflows coming into the banks. It could increase runoffs in the private sector deposits on account of increasing inflation and general economic difficulties. So gradually the level of runoffs or the decay that you observe in these deposits may start going up. And similarly, corporates tend to draw down further on outstanding credit and liquidity facilities issued to them as their inflows curtail, so they have to depend on borrowing more. And there might be reducing willingness or the reluctance of counterparties to continue rolling over interbank deposits as the economic gloom sets in due to internal liquidity challenges. So it may become difficult to borrow in the short term or quickly in the overnight buckets. I mean, interbank markets are something which are typically very resilient and continue to function, given the regulator support. But you could see other forms of stress in terms of pricing of these deposits, that may happen over the time. And to tame the inflation, and the regulators are taking a number of steps to increase the interest rates and combined with higher liquidity premiums because of the prevailing liquidity situation. So it may increase the cost of deposits and curtail the ability of banks to borrow cheaply, and therefore impact the credit issuance on the asset side. So this is how the current scenario could impact liquidity. And in terms of the debt exchange, how it could help with this scenario is from an immediate perspective in terms of the liquidity risk measures. Given that theoretically the available HQLA with the banks will remain same, given the notional amount or the book amounts of these debt instruments is going to remain exactly the same. It's just that the tenors are going to be restructured. So therefore, I mean, again, these are still going to be backed or issued by the sovereign. So the from a qualification perspective, the HQLA is going to remain same. And from a gapping perspective, the contractual profile of this portfolio will shift from the current maturity profile to more longer tenors, like 5 to 15 years, given the profile where the majority of the portfolios are going to move towards the 15 years, where more than 40% of the exchange program is going to sit in the 15-year buckets. So this will definitely impact the contractual maturity gaps, and and this may need a revision in terms of the limit setup for these maturity mismatch gaps. The behavioral gaps will still be subject to whether HQLA instruments are being slotted as per their behavioral liquidity profile and haircuts applicable. So that is something that banks need to relook at in terms of how they slot these instruments in their behavioral liquidity profile, and what kind of haircuts if any would change. And to the extent possible, like banks can slot these in the short-term buckets, taking into account the haircuts as I just mentioned. And in terms of medium to long term, of course, I mean, this will enable the government to kickstart the fiscal policy that will start to relieve the liquidity concerns. And when positive sentiment returns to the market, the liquidity situation automatically improves, and the banks will adjust to the the new normal. And in terms of the macroeconomic view, so this may increase the spending on the government will be free to spend on public goods and capital investments rather than repay the debt, and given that this will also lead to unlocking the IMF support program, so this may kickstart a virtuous cycle where there's increase in money circulation in the economy, and thereby the level of liquidity available in the system will go up, and then further creditations will increase. But however, in the context of the liquidity and business planning, so it is important that banks keep a close view on both the asset and liability growth to ensure that their the liquidity risk parameters are within their risk tolerances, subject to these growth being activated. I think that with that we conclude the session. Sorry, I think we went overboard, but hopefully the session was useful.
Thank you, Satya. I think we'll just take 2 questions for now, and if there are any other questions, we can always have people write it for us. So I think the first question, I think you've spoken about it, but just to reiterate, Mr. Saidik Arthur asked Satya to you, what is your view of the ongoing developments in Ghana regarding the debt exchange program vis-a-vis how government securities are classified under it?
Yeah, I think this is answered. Yeah. So this is the exact point. So these securities are still going to be backed by the sovereign.
Okay. And the second question, Kautuk, it's for you. If you can maybe speak a bit more on modeling of
Sure.
strategic.
Sorry, Pratik, I think I lost your voice again. But
Sure.
if I can read the question directly from my screen, I think it's mentioned that I would like the first presenter to speak a little more on the modeling of reputation and strategic and regulatory risk for ICAAP and share with us some parameters. Okay, so I will very quickly show an illustrative, schematic in which that can be done. For instance, yeah, I hope you guys can see my screen. So a typical way in which this can be done, for instance, as we've already mentioned, say the strategic or the reputation risk generally are measured via qualitative or subjective approaches. Now, the most commonly used approach to do this is basically via a scorecard based approach. So what one typically does is that say within the pillar 2 assessment, and there are more sophisticated approaches where even the ancillary risks are tabbed in this. So for instance, reputation risk is slightly more complicated in terms of its measurement, because the reputation risk not only comes as a primary risk but also as an ancillary risk. So for instance, a reputation risk can also crystallize into a liquidity risk, say in a scenario like run, whereas reputation risk could also come as a derivative of, say, an IT or a cyber risk based event. So it can happen both ways. But assuming on a simplistic basis, the bank wishes to gauge the reputation risk via a scorecard based approach. Typically, a scorecard like this is formulated using the subject matter expertise that an advisor like us brings with our experience across the globe and working with different regulators. So we have a set of parameters that we have seen across banks and across regulators are being focused upon. For these parameters, we do internal workshops with the relevant team members and see their response. So for example, a simple event like for reputation risk, number of significant operational losses or events happening in a particular financial year. It includes ATM, credit card skimming, hacking, payment, or gateway. So any of this would have an adverse impact on the reputation of the bank, and then the impact is basically assessed after you have the feedback from the relevant team members. So on all of these parameters you get the feedback. So basically operationally how you could envisage this is that you circulate a particular template and say I have, say, a pre-filled template. I would just circulate it across different stakeholders and then upload it within my tool. This would gauge all the feedback coming from all of those stakeholders, and at the end what I get is a score across these dozen modules. So across these dozen modules I have the score coming in terms of their feedback, which gives me finally a weighted score, and this weighted score is then slotted across 4 different threshold criteria where a pillar 1 plus approach is used. So basically, because all of this originally spans from operational risk comes from people, process, procedures, and so on. So because this is a pillar 1 plus approach, the bank then keeps this much amount of charge as per the level of your particular score over and above your pillar 1 charge. So this is called a pillar 1 approach, and the level of this pillar 1 charge is determined on what score do you get at the end of this exercise. Similarly, for your strategic risk also, to your top or executive management, you circulate a particular scorecard which is developed internally and jointly with the bank, and then when the score is accumulated or collated in terms of feedback, basically the final score represents the level of strategic initiatives that you have. So again, the approach remains the same. It's a pillar 1 plus approach, and it will give you an idea about how much capital over and above the pillar 1 operational risk you need to keep. So this is the most commonly used approach. There are other advanced approaches as well. We're using banks own data or industry collated data, loss data estimation, or internal simulation based models can also be built. But again, just to reiterate, this is the most commonly used approach when it comes to reputation or strategic risk. So,
Thank you, Kautuk. I hope this answers the question. I'm sorry, I've been facing a bit of internet lag today at my end, but I will, sort of request Audrey to maybe do the closing remarks before we end. Just for everyone's benefit, we will also be sharing the recording of this webinar via emails that you have shared with us, so that if in case people who have joined late or missed out on some areas that they would want to relook at, it will be available for you to view at your own convenience. Thank you. I'll invite Audrey to do the closing. I think Audrey is not available, but thank you so much everyone for joining us today. We really appreciate it. And if any of you guys have any questions, please feel free to reach out to us. With that, I'll close the. Okay, I think Audrey wants to get unmuted. Just a second. Audrey, I have enabled your. I think there's some issues. I'm not able to unmute Audrey. But thank you so much, everyone, for joining. Have a nice day. Thank you.
Everyone. Thank you.
Thank you. Thank you, everyone.